Welcome and thanks for joining us. My name is Steve Seeger and I'm the Director of Acquisitions and Investor Relations here at SNS Capital Group. Today's video, we're going to talk about how it is difficult for accredited investors not only to find opportunities, but to actually evaluate them. Accreditation may qualify you to invest, but it doesn't necessarily prepare you to analyze a deal. And that's why we created this three-part video series where I'm going to sit down with SNS Capital Group co-founder and CEO Jared Sturm. I'm going to ask him a wide variety of questions about the basics of multifamily syndication investing, from key terms to debt structure. We're going to tackle a lot here, and that's why we're breaking it down so you can understand it in bite-sized pieces. Each part's going to cover a different stage of our process, and we'll give you a clear framework for how you can evaluate deals and understand these key terms that make up these different alternative investments. So our goal is straightforward. It's to educate and be transparent. And we want you to see exactly how we evaluate multifamily deals so you can make a confident, informed decision as a limited partner. Let's jump in. Jared, thanks for joining me today. I'm really excited about this video series. And we're going to jump on in here on part one, talking about what exactly is alternative investing and what is a syndication. I mean, I'm going to kind of just go high level and give you the opportunity to highlight what does a real world alternative investment look like for us in the context of multifamily. So I guess to kick things off, my first question for you would be, in your own words, what is a syndication deal?
Syndication is just a partnership. So collaboration between a bunch of people to go take down a venture together.
Okay.
Right. So I think what I've heard that resonated with me when I was really early in understanding this concept is kind of like the idea of buying an airplane ticket and flying this massive jet across the country would not be possible for an individual to do on their own. So even getting on a Delta airplane is somewhat like a form of syndication, because you're partnering with all these other people to be able to afford to fly this massive jet across the country. And otherwise you wouldn't have been able to do that yourself. Take that same concept and apply it to a large apartment building. Maybe you couldn't buy it on your own, but with 50, 100 people, we can do that just fine and operate it, purchase it and operate it very safely, just like the plane.
So what sort of roles are there within that I know I've heard general partner, limited partner. Can you walk me through those terms and what I should understand?
Yeah, I think the layers often are described as the capital stack, and like who's in it, who's in that stack of money, and where do they lie.
Yeah.
But and not to overcomplicate it, but the most common is going to be general partners. Those are the ones putting the deal together, usually have the operational control. And limited partners, those are the ones that are passive by nature, more of just writing a check and contributing to the venture.
Okay.
So you could think of, like in the airplane example, the general partner is going to be the pilot and the flight attendants and Delta as the company.
Yeah.
But then the limited partners are the passengers. They're not actively flying the plane, but they're benefiting from the trip.
Where does the risk level lie for each level in the capital stack? I'd imagine that there's higher levels of risk for certain seats.
It all depends on the structure, but you're right. Like by common is that the limited partners, in the sense of the word limited, part of that is limited risk, and they are limited in their risk to the amount that they contribute in. So if an investor puts $100,000 in, the maximum that they could lose is $100,000. That's how our structure works. That's how most syndication structure works. They're not exposed to legal risk or loan guarantees, to where if something goes sideways, banks or creditors are coming after their personal assets. And so from a risk exposure, I would say the general partners usually absorb the majority of it, and that's why they get a cut of the equity beyond the money that they contribute.
Yeah.
And that's part of the incentive for the general partner.
Okay. And I hear the term a lot, skin in the game and alignment of interest, thrown around. Where does that come into play here with this general partner and limited partner relationship?
Yeah, skin in the game, alignment of interest is all about just making sure incentives are lined up, because at the end of the day, if you're a limited partner and you're giving up control to this general partner, usually full control, you want to know, like, well, why, how much and why are you going to care when things get hard and you have to work really hard? So skin in the game oftentimes gets attributed to dollars into the deal. So like how much are the general partners, the people that have that control, the pilots on our analogy, how much skin do they have in the game? And so, meaning how much do they have on the line? A lot of times investors focus on just the dollars in. So, they ask us, how much are you contributing into the deal? So we'll answer that question. But I think what people miss frequently is there's, in my opinion, lots of forms of skin in the game. There could be that we personally signed on the loan, right? So like that whole big, massive multi-million-dollar loan, we signed some form of personal guarantee to where if we don't perform and for some reason the loan defaults, they're coming back at my house, my cars, my personal bank accounts.
Yeah.
That is a huge amount of skin in the game. And then there's also friends, family. Your skin can also be your relationships and your network and your reputation as a general partner. So you don't want to lose that, and if a deal goes sideways, you're going to work really hard to correct that to make sure you're not impacting those who are close to you financially, and also the reputation that a lot of us spend decades building. So there's different layers of skin in the game, and I think too often people focus exclusively on the dollars, which we stand out on that because we oftentimes are contributing quite a bit of money, more than the industry standard, into our deals. But we also are oftentimes even more skin in the game on those other components than most syndication sponsors.
Yeah, I like that analogy too, the pilot analogy. I mean, they're definitely incentivized to get you to the next.
So imagine on the analogy, the pilot is flying the plane remotely from home, right, on his laptop. And you would think, I'm a little more concerned if he's paying attention because his life isn't on the line, as opposed to you're sitting in the cockpit and driving this plane and flying the plane, and if you crash it, you're going down too. Yeah. That's the whole concept, right? You just may have that question in your mind of like, wait a minute, why doesn't that make me comfortable? And the same thing happens in investments.
Well, I guess my next question on that is, for these limited partners that want to get involved in these deals, it's less common than maybe buying an index fund or opening a brokerage account somewhere. How or what levels and hoops do they need to jump through to get to that point? And are there any sort of terms that you think are worth highlighting here? And
I mean, I know you're sitting in the seat of an LP, but like you would probably be better to speak to this with your Series 7 and your background in financial advisory. Like for me, this is all I've ever known. So alternative investing for me doesn't feel like an alternative. It is my primary. Yeah. So, but I do understand that the market in general is like the common practice, and where most of America's wealth is in 401ks that are funneled into index funds and bonds and some proportion of that. And that's where a lot of financial advisors will suggest shifting into what the investment world deems as alternative. A lot of times those are going to be restricted to accredited investors. Not always, but a lot of times, and specifically for SNS, we're raising money from accredited investors. So there's going to be high income earners or high net worth individuals that meet the SEC's guidelines to be what they deem as safe to be able to be risking this amount of money into alternative investments with less red tape, less oversight from the government.
What are those levels that they need to meet, those thresholds?
There's quite a few ways to meet that, but the most common is going to be your income.
Okay.
So an individual, like an unmarried person on a tax return, needs to make $200,000 for the previous 2 years with the expectation to continue that threshold in the current year. Or if you're married, it's $300,000, the same thing.
Yeah.
But I have found that the easiest threshold to make is the net worth one. So net worth of $1 million, excluding your primary residence. So if you do have a big old healthy 401k or stock portfolio that's in maybe a couple rental properties, like you can get to that $1 million pretty quickly. And being a millionaire by net worth today is significantly easier because of inflationary pressures than it was 40 something years ago when they put that threshold in place and have yet to move it.
Okay.
And then the final one that I'll kind of just brush on is like you could have your Series 7 or other kind of licenses that show the SEC that you have a level of sophistication that you can make this investment wisely. And really what all of that's for, why the SEC put these rules in place, is to protect the average person from getting swindled, right? Because the way they're looking at it is, if you have $1 million, if you make that much money a year in income, you can absorb the loss if something doesn't work out, where maybe the average person if you have unfortunately, if you were to have like a snake oil salesman raising money for syndication, walking around at a retirement home raising money from people who can't afford to lose it. So they put this in place to protect those people. And we need to comply with that, and we do comply with that. But fortunately for us, the inflationary pressures has made it more accessible for more and more people as they haven't moved that threshold of income or net worth.
Okay, so I'm just going to restate that to make sure I got it right. The first is the income. So as an individual, you would have to have made $200,000 the last 2 years with the expectation that you'll make it moving forward. And then the alternative to that would be $300,000 if you have a spouse, and that would be the same sort of guideline where the previous 2 years would have to be met with the expectation of moving forward. And then the last one, the other option would be the net worth, which you're saying is probably the easier one to try to hit. So $1 million.
Yeah, and I think I should have said it, and you said it, but it's not all of them, right? It's one of them, as long as you meet one of those qualifications. So let's say I make $100,000 a year, but I have a net worth of $2 million. I'm good to go. Right?
Okay.
I qualify as an accredited investor, and per the SEC, I can invest into these alternative investments like SNS Capital Group's alternative offerings.
Okay, that's real helpful. I do want to talk about what different kind of strategies come into play for these different alternative investing options. And the way that I want to demonstrate that is by pulling up, and I'll throw on the screen here, a graphic showing the buy box that SNS uses to help demonstrate the type of properties that we target and our investment philosophy. And you can add to that as we move, but that's going to be thrown up now, and I was hoping that you could walk me through what exactly type of deals do we buy, and then we'll dig a little bit deeper in from there.
Okay. Well, I'll start really broad. I would say, like, when you say what kind of strategies can fall under the alternative investment blanket, I would say a tremendous amount. You know?
Okay.
And one thing that SNS does is we dial in extremely niche, right? Extremely niche in the asset class, extremely niche in the geographic location of what we buy. But alternative investing can be precious metals, it can be oil and gas, it could be real estate, it could be specific niches within real estate, it could be, investing in private companies of all kinds. And so I would say, alternative investing brings a lot of options, a lot more, in my opinion, than the typical path of mutual funds and bonds. But what we know and what we do is specifically private equity within real estate. And we do not even funds of real estate, we do specific asset offerings. So we identify a single apartment community, we put that apartment community under contract, then we produce an offering memorandum to outline here's why we like this apartment community, what returns we believe it will produce, what the business model is. And then we present that to potential investors, and then they decide if it's a fit for their portfolio. And then, even more specifically, we're just in Greater Cincinnati, we're just doing multifamily, we're just doing C-to-B class multifamily, and we're just doing value add. So like, there are plenty of groups, and this isn't a right or wrong, but there's plenty of groups that broaden that horizon under the blanket of alternative investing. And the question that new investors need to ask is like, well, what am I looking to participate in, and what kind of responsibilities am I looking for my general partner to control, and do they have that sophistication level and experience to control what they're pursuing? So we're really good at one thing and not good at other things, and we don't try to go do those things, right? I'm not going to try to say we're going to go buy office just because office buildings are down in value, because I don't know how to operate offices, and I definitely don't know how to go drill for oil and gas. And so I think the lesson that I'm trying to convey here too long-windedly is limited partners, when beginning to explore private equity and specifically, or even more broadly, alternative investments, they need to be thinking about who am I giving up this money to, and do they have the skill sets to then run the back end business? Because I don't think you have to think about that as much when you're thinking about Apple stock, right? They're taking care of that on their own because of their size and their scope, and you don't really have to put a lot of bandwidth into that thought.
Yeah. Now, what specifically kind of deals, and that's extremely helpful for me, what kind of deals in Cincinnati in multifamily are we buying? from there? I mean, what year? Because I'm going to show this graphic and I want to
Okay.
outline that way they can understand, our investors, what exactly that means.
Yeah. Vintage would be somewhere between like 1960s and 2000. That's our current portfolio. Some people might better define or more commonly define that as C to B class multifamily. But what that means for the less familiar is kind of like it's the housing that accommodates the average renter, right? It's not the apartment community with 3 pools and a movie theater and a couple gyms. Like, it's not that.
So will be Class A?
That'd be Class A. And then Class D is going to be things that are like heavily subsidized, a lot of Section 8, maybe some communities that would be difficult to staff because of crime and the resident base is just a challenge to operate within. So we're just settling into the middle, catering to the masses, and also then looking for those assets that are poorly run, and then poorly run through the operations or needing construction to improve those. And that's how we add value. That's how we generate a lot of our returns, is finding upside. And so I think that when LP investors are considering this type of private equity, they need to also consider, what am I trying to accomplish? And then aligning themselves with a general partner who is very good at accomplishing that. So we focus at a high level on consistent, predictable cash flow, long-term holds. Is that what you as an investor want? Or are you looking for something that you can jump in and out of in 6 months, 12 months, and you should be lending money to single-family flippers, and that's not us.
Yeah.
And so I think that understanding the model and the outcome that model produces is very important for investors to consider.
And how big are these deals that you're buying typically?
So are you asking on dollars or unit count or
both?
Okay, so like our average community is going to be about 100 units, which I would say is slightly above mom and pops buyers. Like, you're not going to get just like a high net worth individual buying these, but you're also not going to get the institutions that need $50 to $100 million transaction to make sense of it. And so the unit count is going to be somewhere between like 100 and 200 right now. That's where we're finding opportunity, and that's going to translate into something like $10 to $30 million in purchase price.
Okay. Walk me through, just to wrap up here, what does a typical investment with SNS, as an example, look like? So the viewer here can understand, like, what exactly am I putting my money into, and when am I going to get my money back in the context, I guess, of an SNS deal?
Yeah, I think people overcomplicate that. Right? Because at the end of the day, we are buying an asset, a real estate asset, and we're going to put that asset into an LLC. And it's not all that uncommon from if John Smith and his significant other went and bought a single family rental. Like, it's the same thing. They would likely create an entity for asset protection, an LLC, and then that LLC would buy that real estate, and they would own, in that example, 100% of that LLC. In our structure, we create an entity, an LLC, so we'll call it like Apartment Holding LLC, and then that LLC is purchasing this large apartment community for $10 to $30 million. And the investor is buying a portion of that LLC. So rather than own 100% in our single family example, you might own 5% or 1%, depending on the scale of the equity raise. But if we have to raise $10 million and someone puts in $1 million, they're going to own 10% of that, right? And so it's just, or probably more realistically, if they put in $100,000 into that $10 million raise, they're going to own 1% of it. But it's 1% of a much bigger pie, right? So the cash flow, the tax benefits, all the things that people, I think, understand about buying a single family rental flow back to that LLC, and then flow through that LLC back to the owner, just as they would if you owned it on your own.
And so we'll dig into this in a later video in the series, but are the returns that you can get from a alternative syndication deal, in this case, comparable to what you could achieve on your own owning that single family?
So the reason that general partners do this is because they do take a cut of the equity. Our split, which I'm thinking we're going to get into later, is 30%. So 70% goes to LPs, 30% goes to GPs. I won't dig into that too much. But even with that equity split coming to SNS, the answer to your question is yes. Oftentimes we beat what active investors can produce in small self-run portfolios because they don't have, it's not what they do full time, right? So this is all we do. We have economies of scale. We have over 2,000 apartments all in one area. So we're able to operate just far more efficiently and with a lot more attention. So if you go buy that single family house, potentially you could produce better returns if you get a really good deal and you're very focused on operating it. But you also have to factor in the active component of it, right? You're the one leasing it, or you're paying a property manager, you're managing that manager. And then I'll also add that oftentimes you have to, as an alternative investment, beat what those bonds and mutual funds could produce, because that's where more people are more comfortable with. They perceive it as less risk, and therefore with more risk in alternative investments, it needs to come with something, and that something is usually higher returns. So what we're targeting is, a 10% cash on cash return excluding the sale, an IRR of 12 or more. And so those are return metrics that significantly beat the non-alternative investments and oftentimes beat what individuals could do in a single family home. And those numbers are not the specific, not the full business returns, but that's what the individual investor would receive, right?
Okay.
So through those distributions, and a lot of that's heavily tax advantaged. So hopefully that answers your question.
It does, and we'll dig into that too in part 2. And thank you for taking the time to sit here with part 1. We're excited to jump ahead now.
All right, thanks.
That'll wrap up part 1 of our video series. Now you should have a better basic understanding and a strong foundation on the basics of real estate syndications. And in part 2, we're going to dive deeper into the metrics that matter most when evaluating multifamily deals. That way you can look beyond the surface and truly understand the numbers that are in front of you.